Yeah, it's great to see you, Ed. Thanks for coming in.
Yeah, thanks for having me. I'm looking forward to our conversation today.
As you're well aware, 2025 has been a great year for a lot of the metals markets. Looking at Bloomberg data, if you dive in and look at how ETFs are performing, over the top 4,000 ETFs, 16 out of 17 are actually miners of precious metals or critical materials. So from that standpoint, we've seen a lot of interest, not only from investors. It'd be great to spend some time to talk a little bit about what you're seeing from an advisor perspective.
Sure. So advisors are certainly taking notice. We've always had our core advisors that, I guess in the past they called them gold bugs and even silver bugs for that matter. But now we're seeing more advisors start to look at this space in a real way. As more and more investors are looking for alternative strategies, gold is stepping into that spot. You know, the old 60-40 model tends to be broken if you talk about, advisors and you talk about big banks. Jamie Dimon saying it's really 60-20-20 now, with 20% being alternatives, and in there is gold. More advisors are starting to embrace that as well. So still feels like early days as far as advisors looking at gold as an alternative asset and not just as a currency. And as more investors look to diversify their portfolio, gold is definitely taking charge on that.
Yeah, gold miners, as you bring up gold, is one of those sectors that's really been on the outside looking in for the better part of 15 years. And now they're among the best performing sectors that we've seen. But despite of that, we're still seeing about $4.5 billion in outflows in the largest gold mining ETFs. What's been the reaction when you talk to clients around gold miners, and how are they viewing those as part of their portfolio?
The gold miners are really a hot topic right now. What's interesting about gold miners and what you just mentioned about the outflows is that many of the advisors and investors started buying the miners 2009, 2010, and the market peaked in 2011. So there is a core group of investors that are really just getting back to even or finally back in the money. And so they're realizing that and saying, hey, this was a long time to get back to even. I'm going to move on to something else. Having said that, though, with gold and silver doing so well and the miners doing so well with some of the best balance sheets out there, it's not just the returns. They have better dividend yields than the S&P 500. The return on invested capital is more attractive. They're less leveraged than many of the companies out there today. And so there's a new wave of investors starting to pay attention to this. So I think we're getting kind of out with the old, and I mean old, and then old capital's coming out, they've broken even, but new capital is starting to show up and starting to participate in this space. So like gold and silver, again, feel like it's kind of the early days as far as advisors looking at mining stocks as a unique way to add risk on to their portfolio. And I think it's worth also mentioning that so often people think, well, if I'm going to invest in gold or I'm going to invest in silver, why not just do the miners because I can get torqued to the trade? And I always like to say the physical market and the equity market are very different investments. The physical market is still more of a risk-off diversification investment, and the miners are more of a risk-on opportunistic investment. And so that's how you really need to think about it. And as we work with more and more advisors, we really help them go through that allocation and think about how much they should have in the physical market, and does it make sense or is it appropriate for their clients to start looking at the miners as well? The answer is starting to be more and more, yes it is, and advisors are starting to look at miners today.
It's a great point you bring up about those investors that have been invested in miners for so long and moving out of the gold trade. We do see that new money starting to come in. We earlier this year launched the GBUG, which is our Sprott active gold and silver mining ETF. That's actually gotten a lot of traction. It's the only active strategy out there on the market as it relates to gold mining. With that, kind of the value proposition there is we tend to see a lot of dispersion in returns between different companies within the gold mining sector, and an active strategy could help investors outperform, the broader gold equity market. When you're having these conversations with investors, how do you choose between gold and passive and active strategies? How are advisors thinking about those options?
Yeah, you said a key word there, active. Sprott's had a factor-based suite of ETFs for a while. We've got a senior mining ETF and we have a junior mining ETF. But to your point, GBUG is something that's newer, and we're finding more and more investors are looking at the active side of this equation. As you go down to market cap, as you go into corners of the room like mining stocks, advisors want to have a more hands-on approach to the allocation of the individual names in those portfolios. So while a passive strategy or even a factor-based strategy may be appropriate for a core allocation, for an advisor who is really looking to go into this, particularly for the first time, They want that additional umbrella of an active manager going out there and looking at the best names out there. So we're starting to see, as more investors start to think about miners, in some cases for the very first time, they are leaning more towards that active approach. It's one of the few spaces out there today, particularly in the world of ETFs, where active management is starting to gain real traction.
Yeah, related to gold is silver miners. Obviously, you can't talk about gold without talking about silver. Over the last several years, I think many in the market have been waiting for this catch-up trade to happen in silver, and we're actually starting to see that now. Physical silver's outperformed physical gold now by about 50% year to date. So very strong performance that we're seeing out of silver. It's also a little bit more unique than what we see out of gold, where gold is that precious metals allocation. Silver is kind of a dual metal where it has not only precious metals allocation, but it also has about 60% of demand is actually coming from industrial uses. And it's mined differently. It's not, most miners aren't going out and mining silver specifically. It's a byproduct in many cases. With these different characteristics, how should investors be thinking about allocations to silver and silver miners in relation to their overall portfolio?
Silver is a really fascinating metal today, because when you think about the history of gold and silver together, most advisors would talk about the gold to silver ratio. How many ounces of silver do I have to buy an ounce of gold? And that was always kind of in lockstep with each other. Silver's really stepping out of gold's shadow today. Gold is still truly a monetary metal, where silver, as you mentioned, is going from being maybe a lesser monetary metal to a true industrial metal. It's getting consumed. And yes, it's still a precious metal, but more and more of its consumption is going on the industrial side of things. So in many cases, advisors who are looking at precious metals for the first time, they're able to embrace the silver story a little more than they can or are willing to embrace the gold story. The one knock I hear all the time from advisors about gold is it doesn't do anything, it doesn't pay a dividend, it doesn't have a purpose outside of backstopping maybe paper currencies and so forth. Well, this move of silver stepping out of gold's shadow and going into the industrial application side, advisors can get their mind around that and say, okay, I see the purpose behind silver. I can convey that to my clients. We understand how that works and how that looks. And when you're starting to see the bid for silver get higher and higher, and as you mentioned, it's over $60 an ounce today. It's doubled what gold has done year to date from a performance pattern standpoint. We think that's going to continue as the easy stuff's largely been had. Is being consumed at a higher rate, and things like solar panels and camera technologies and all the other things that silver is being used for is continuing to grow. We really like the silver story today.
Yeah, and silver is a great segue into critical materials because countries are increasingly looking at silver as a critical material. When you look at the options that are available to investors, within the last couple of years, we've launched a number of ETFs that provide individual exposure to mining companies. So, for example, if you want to access uranium miners, copper miners, lithium, nickel, and so on. One of the funds that has done really well, and I know it's one of your favorite funds, is our Sprott Critical Materials ETF, ticker SETM. This is a fund that gives broad-based exposure to pure play mining companies of up to 9 different critical materials. I know you've had a lot of conversations as you're out in the field. What's drawing advisors to SETM?
You're asking me about my favorite child right now. SETM is a really cool ETF because advisors understand the value of having some uranium, having some copper, having some battery metals in there, that we have a full litany of different battery metal solutions out there as well. The problem advisors face is this is one in many themes they're trying to allocate capital to. So in many times I hear them say, well, I have one line item on my balance sheet to take advantage of the energy transition or the energy addition movement that we're having out there. How do I profit from that? So many of our advisors, investors have participated as a consumer, right? They're getting electricity through solar panels, or maybe they're buying an electric car, maybe they bought their first Tesla. But they haven't really participated as an investor. And so our whole suite of ETFs are really allowing investors to do that. And what's really cool about SETM is that it gives you exposure approximately to a third of the creation of energy, which is predominantly through uranium for nuclear and silver for solar. There is some rare earth in there as well, but that's really your exposure on the creation side. Then you have the movement or transmission of energy, which is predominantly copper. And then you have the storage of energy, which are all the different battery metals that we offer. And so for an advisor, they can say, I have one ticket, one ETF, one line item, and I'm giving the full package, the full exposure, the full experience to my client, and really encapsulating everything that's happening in that space right now. So yes, SCTM happens to be my favorite just because it's a very eloquent solution on how to participate in this space today.
Yeah, and you mentioned rare earths and SCTM. That's about a 15% allocation there. We find that, given the news we've seen around that, a lot of investors are gravitating to SCTM for that reason, because it does allow them that broader-based exposure without having to pick winners and losers of each of the individual metals, because they do all react differently. They have different supply and demand dynamics. So it's been a great story, I think. And well, it's great having a chance to catch up with you today, Ed, and I'm sure we'll be back on here in no time.
Steve, this was fun. Thank you for the questions you had today, and hopefully the advisors and investors that are watching this will learn a bit about who we are and what we're doing.